So you're stuck with me again, but we have a nice new panel, and we're going to take a step back. Last one we talked a little bit about process, but on this one we're going to take a step back and talk a bit about the genesis of strategy and how do you think about the buy, build, partner, invest question, and we'll start there and we'll move on. So Mark, maybe I can start with you. When you've decided that there's something you want to do strategically, do you decide up front that you're going to buy versus build versus invest, or is it something that you figure out along the way, or is it more opportunistic than that?
It is very much that entire process. And first and foremost, I should say thank you for everyone who's coming out this morning, and thank you for all the sponsors for the invitation to come. So thank you. We are a classic buy, build, partner organization. So no matter the size of the transaction we're looking at, that is the analysis we do, and we work with our teams to try to be honest brokers against that. And I think Sexum has some good stories relative to that. But to look at each one of those things separately and be honest about and not sway the field, so to speak, about what really is the important goal of why we're looking at this strategic area.
So Sexum means I teased it up, right? So tell us the story.
You totally set me up. You set me up. Okay. So the story I was sharing with Mark last night really has to do with this, which is I was at a company where we had made a decision that we would grow into, I'll just call it broadly speaking, the enterprise as a company that had been largely consumer. And really, again, the job is to be an honest broker. I mean, I think of the best corp dev as like we're representing the shareholders, and that, yes, we report in through kind of the executive suite and so on, but if we're doing our job, we aren't trying to sway things. And I'm guessing that many of us will see times where execs will fall in love with the shiny toy that represents the strategy. And so I frequently find myself being in the role of not just kind of deflecting the idea that this is the thing we have to buy and it doesn't matter what it's going to cost and how awesome they are, but it's really kind of broadening the lens of analysis and then bringing in the idea like, oh, why like what are there any other substitutes for that? Why don't we partner to see if we really want to be in this segment or not, and so on. And so the actual story was that the head of the company really wanted to do a deal with the shiny toy. And I told him I did not feel comfortable working on that deal because the analysis was less than robust. He looked at me and he said, "No problem, I'll just have the GC do it." So he did it. Moved on.
So Lisa, I saw you laugh a bit at that. You're still laughing at the topic. Maybe you could talk about how do you work, Amex is a big company, how do you work with the different business units and help them work through this? Is that just a bright, shiny new toy, or is it something that you should actually do?
Yeah, so I think I said yesterday, is that on? Yeah?
Yep.
Interesting doesn't cut it for us. I think somebody said this in the panel before. There has to be a strategic hypothesis and thesis for why and what an acquisition is going to be. And we spend a lot of time with our business partners on why are we a better owner? If we own it, where are synergy values? And it is a bit of an exercise. I do think I found the perfect company. My job is to say, and here's 5 others that look just like it or close enough to it so we can have a good discussion and debate. But I do think sometimes people look at corp dev in the room and assume it's an M&A conversation. We are what I like to call full service providers, and so we will meet a ton of companies and we will be the first one to say this might end in partnership, but we're still a good place to start because we can help you navigate the organization. We can tell you whose strategies are important and who you should be talking to make the best match possible.
So I think this question of corporate development as gatekeepers has come up a bit. So maybe Chris, can you talk about how you build relationships? So how you think about building relationships and how companies and founders who have done it well have built relationships with you in your business.
Yeah, absolutely. So I think to the gatekeeper point, there are at most large companies, people tend to be pretty insular. It's all about, in our case, Atlassian, Microsoft, Twitter, whatever it might be. They don't often pick their heads up and say, what's out there? How should I be thinking strategically? What companies are coming up? What should we be thinking about? And so I think the advantage of someone working in corp dev or partnerships are that we're externally focused, right? We're always thinking about the market. We're always thinking about what's next. We're trying to start relationships with good entrepreneurs. We're trying to make sure that our management team's informed about what's going on around us. And so we end up being a great mechanism for you, the entrepreneur, to understand how you can navigate Atlassian. And I will tell you, at least in our case, like corp dev is not buying company. Corp dev is fostering people to figure out if we should buy a company or not, right? And so it's a quarterback game. But we're there because we want to foster a relationship. And to your point earlier, it's like we want the best outcome possible for the company, whether that be partnership, some sort of OEM relationship, or ultimately acquisition. We want to make sure that we're fostering those relationships in a good way.
So the word partnerships come up a bunch. Maybe, Lisa, can you talk about the Amex partnership network? I mean, I can't think of a company that has more partners than Amex. And how do you think about that as it relates to corporate development and investments and your strategy?
Yeah, so, I mean, I think our best friends inside Amex are the other biz dev teams, and we spend a lot of time just chatting about relationships, how we think about the world. You know, the ventures group is a natural sort of tie-in to our partnerships group because that's where we are experimenting, right? It is not necessarily a foregone conclusion that a company that we invest in we're going to acquire, but it is a way for us to say, here's a unique technology or here's a unique customer experience that we want to learn more about. So I think there's a lot of tie-ins between how we think about ventures and partnerships, and we have a stated goal of having at least 2/3 of our venture companies having an operating agreement, a pilot, a test, or a marketing agreement within sort of 12 to 18 months of an investment. And so it is something we spend a lot of time thinking about. I would also say partnerships are a good way to figure out if there is an M&A opportunity. And so sometimes we'll have our partnerships team show up and who say, oh my God, we partnered with this company, we didn't think it was going to work as well as it did. Now we want to get married, and we then start a different kind of dialogue with the company. So it's a bit of a continuum for us.
So, Mark and Sexton, for you, if I think about your two companies, they're large businesses, but they're very large potential markets. So the opportunity set for how you could think of M&A seems quite broad to me. How do you prioritize that on any given day, month, or year?
Well, I would say we're lucky enough to have the resources to not have to make any one business unit prioritize over another. And so within gaming, we look at gaming opportunities. We don't then also look at Azure opportunities versus gaming opportunities and try to figure out which is the best. So we sort of cheat the classical system in that way. But it works for us. And we don't try to force people to, and I think it would in our case, create false narratives that why this is the most important thing the company could do. We bought Minecraft because we thought gaming and Minecraft could really work well together. The gaming assets we already had with Minecraft could really work well together. Not whether or not it would also, which it has, created a flywheel effect in our Azure business as we went out and found other great gaming developers to come onto Azure as an initial platform for them. So that's how we try to think about it.
Yeah, for us, it's gotten a little more straightforward. So at Twitter, clearly we have a very expansive mission, but we've gotten to the point, which seems to be delivered in the execution, that we have very tight focus on what I'd call like a top 8 set of priorities. And so literally my team is told, all you are working on are these top 8 priorities. And if there's something you think you should be working on that's not in the top 8, we bring that to a meeting and we make a group decision on whether this has enough merit based on some other vector that we may not have thought about to do that. And so I'd say it's not a religious thing, but it's probably like 80% of it falls within that. And then there's like a 20% left over that's you can't have thought of everything. And so that's kind of where there's a little bit of room for play.
Chris, I'm going to build on something you said earlier. You said corporate development doesn't buy businesses, which we actually say something similar. I agree with that. What do you do about things that are newer ideas outside of anything that someone's doing? How do you get a business champion to be excited about it when it may not be straight down the fairway from the company?
It's the hardest and most emotional part of our jobs, to be honest with you. I get shiny object syndrome, right? I'll see a company, I'll be like, that's the best thing ever, we should buy it. And I don't have a sponsor, right? And so in that situation, we become influencers, and it's really about the relationships we have with our product folks. In our case, the CEOs of the company. Oh, sorry. Can you hear me now? In our case, the relationships with the CEOs, and making sure that people are informed about it. It goes to the last question I was answering, which is, like, we're externally focused. We do see things that a lot of our product folks won't. We try to engage them. We'll get demos with them and with the companies, and we'll try and get them excited. But ultimately, we do need the sponsor. We need the business sponsor there in order to drive the acquisition. To the point Sexton was just making, hopefully they fit in within our strategy. And if not, we have to figure out whether or not it's within that 20% sort of opportunistic scenario. I think that's exactly right.
So slightly controversial question. We've now said corporate development doesn't buy companies. We've also said that they're the gatekeepers. So you're a CEO and you want to develop a relationship with a company that you think is a good acquirer. How do you build the relationship both with corporate development, but in some respects, maybe what they view as the ultimate decision maker, who's the person in the business who has to be the sponsor?
Just ask. I mean, seriously. I think so many people, when they come in, view me, my ventures team, my M&A team as the end-all be-all conversation because we're responsible for deal execution. If we're not introducing you to business partners after the first conversation, you should ask why. Because it's either not a good fit or we're not ready yet, or whatever somebody said earlier, it takes 3 to 5 years to get some things to happen. Some of that goes to what Chris said, which is we might be doing a lot of work on your behalf to try and drum up enthusiasm. It doesn't mean it's a no, it just means it's a not right now. And so just ask, right? And the more transparent we can be with you, but the more you know what to ask, I think the better off we are.
Yeah, we are incredibly proactive, and I think it's the same for everybody here in the last panel as well. And that for us means the random thing that comes over the transom has a very minuscule probability of actually getting done. And so you should know the people in our business, and you should have a go-to-market relationship with Microsoft, and that should be developed years before you actually want to have the conversation. Now, that all can't always work, and I'm happy to take the phone call at any point in there where you think you want to know whether Microsoft wants to buy you. But the better the relationship, the better and quicker I can actually get back to you and let you know whether indeed we're interested or not.
Yeah, I'd like to add one other point is, in many ways, like developing the relationship with a company is no different than going out as a CEO and getting a piece of business, which is that I think it's really your job to try to understand what's important to, the company you're trying to engage with. Like what are their goals? What are their motivations? Where are they trying to grow? And really be thoughtful, do your research, maybe listen, have conversations. And then like most things, it's like a very human game. And so like understanding better the motivation, like who are the stakeholders that would be critical to a decision, whether that's corp dev plus business unit owner or business unit owner plus product lead or whatever. And just almost like anything else, if you had the time and you knew who the natural people were, you would start to map those relationships and understand kind of what the toggles are. And over time, ideally, you kind of play on that. Now, a lot of people don't have those kind of connections. It's hard to do. But that's in a way why corporate development teams are so great, because like if you have merit, they will actually get you introduced to the people where you have the potential to create that relationship. And to your point, like if you really don't have the potential, the hint is usually there's not a lot of follow-up after.
If I can do the inverse of that. Just yesterday I got a call from an investment banker who said, hey, we got this great company. It's going to be $1 billion plus transaction. We think it makes all the sense for Atlassian to buy. And I was like, I totally agree with you. There's a ton of rationale here. You're giving me 2 weeks to get to an answer on that. It's not happening. Like, it's just not. We're not going to do that. There was no relationships between management teams. There was no relationships with product teams. I knew the company, but hadn't met with the company. The worst thing that you can do if you want to sell a company, and I'll speak for Atlassian, to Atlassian, is make that call and give us no time to respond or get to know you. We're not buying it. It's not going to happen.
I got the same call, but I did not know the company, and it'll be the same outcome.
Yeah, exactly.
Unnamed investment bank calling.
I was going to say that was not at the.
It was not Goldman Sachs.
It was not
Goldman Sachs.
It was not Goldman Sachs. Thank you. So I think that's very clear. I think we got the advice, which I think is good advice for the room and for the few investment bankers in the room too. Maybe we can talk about something we haven't spent that much time on. So we've decided we're going to buy. We've done the relationship building. At some point, there's some analysis that gets done on the business. So can you give some insight into how you think about the numbers, the analysis, maybe at different stages of companies? Give them a little bit of the tests that they're up against.
Go ahead. You want to go for it?
Sure. It all starts. Listen, it all starts with we need to have a keen understanding of the business that we're buying, right? And so it starts with hopefully a really deep analysis around the P's and Q's, literally the baseline elements. How are they driving business? What's going on? How are their sales teams doing? What's the quotas? How are they attaining them? All that sort of stuff. What are the self-serve channels, et cetera, in enterprise software? But then it's what can we do to it, right? And that becomes probably the most complicated analysis because we have to think really deeply around if we're going to buy something, we want to make it better. Either we want to make them better or we want them to make us better. There has to be synergy. And so there's a lot of work that goes into what are those things that we can do? How long is it going to take to get there? Because it does. It takes way more time than you think. The worst thing that can happen is someone will show us an analysis and it's like, you're going to get 20% synergies day one. It's like, no. It takes a long time to get there and there's a big investment in getting there. And so that's the work on our side, but it comes from pattern recognition, right? We've bought a lot of companies in our history. Our teams know what's worked in the past, and we try and leverage our experiences historically in order to feed into the analysis that's happening today.
I mean, I would echo that. I think the clearing price is probably the easiest thing, right? There's a market value, there's what we think the company works. If we have some rough overlap, we'll get a deal done. Once you get through that, I think it is really all about what is the value creation after the transaction closes, because as you know, we as a public company spend a ton of time focused on P&L impact. So the capital, making a decision to buy a company for $200 million isn't what gives us the agita. It is how do we get the product on the roadmap? How much will it cost us to do that? What does it displace that we would have otherwise done? And so it does become very much of a discussion, as you said, around what's the synergy potential. And I'm with you. I say if it takes twice as long and if it's half as much, do we still like the transaction? Because if the answer is yes, then we should do it because no business case ever works out the way it's planned for.
Yes.
So, hey, Mark, can you talk? You said earlier that you can prioritize things in different divisions. How do you handle multiple integrations going on at the same time? Do you get to a point where you just can't do another deal, or do you have a system in place where it's just a Tuesday, you can integrate as many deals as come through your door?
Again, we're lucky enough to have some resources at our disposal. So we flex with outside vendors for that sort of thing. So there are several firms who you can call on a moment's notice who are happy to come and help you with integration. There is some limit. The system can only go so far. Multiple 10,000 person company integrations would be difficult if you were trying to really integrate them into your system. So having everyone on day one, have a Microsoft persona and a badge and all the rest, that would be a little bit difficult. Deal timing is always such that never quite happens that way. And then the 15 or 20 deals we do are relatively small, and so we feel like we can handle those both within the capacity we have in our organization and then the flex capacity we can add.
Sexton, can you talk about some of the deals you've integrated? You did one, I think, to track fake news. It was in a different vertical. How do you think about integrating a business like that, which maybe doesn't have a clear home inside the organization?
Yeah, so on its face, it doesn't seem like it has a clear home. But so as an example in this case, we were buying what looked like a fake news capability. But what it was really about is a kind of a deep ML AI team with one of the top researchers kind of in this case, deep graph learning in the world. And so the whole thesis was really around, for Twitter that is, how do you take kind of a top flight researcher, build a team that can help productize ideas and then move them through the pipe. And so as we thought about integration, it was really like, how are we gonna take what they have and multiply by building Twitter around it?
Great. So I'm gonna ask two more questions and then we'll be willing to open it up to the floor for questions. So Chris, there was a conversation in the last panel which said, just tell us what your terms are. Just just tell us what the terms are. So I think you went to the next phase of that and put your term sheet
Yeah,
up.
so thank you. I love the plug. Thank you very much. So a little backstory. So as with all companies, I think especially in technology, we're a very values-driven company. One of our core values at the end of the day ends up being transparency. And when I joined Atlassian, I had a long conversation with our chief legal officer about the M&A process. And for what it's worth, we glorify the M&A process, but it sucks. It's a horrible, horrible process. You'll be stressed out. We know a lot about M&A. You know nothing about M&A, right? And so it's a really, there's a delta in information. And we talked about ways that we could fix that. And at the end of the day, we wanted to break down the opaqueness of the M&A process itself. And we spent about a year really looking at data, really understanding what was the risk profile we were willing to take on our terms. And then we published it. And to our knowledge, no one has ever published a term sheet before. If you are interested in M&A, I highly recommend you take a look at it. It's called the Atlassian term sheet. But our goal is really to give entrepreneurs a little bit more perspective and information with a goal to let you come into the process knowing a little bit more, knowing why we're approaching things the way we're approaching them, knowing that our terms are our terms at the same time. We're hoping to make a lot more of an efficient process. But ultimately, we felt like if we were able to break down those knowledge barriers and the dislocation of information between the two of us, we could have a better process. You'd come into Atlassian healthier and more informed about what was going on, and we could start talking about integration and making us better together relative to negotiating really inane risks that don't ever happen. Honestly, it was really coming down to that.
How many hours did you spend with your lawyers doing that term sheet?
More than I'd like to talk about. But seriously, it took us a year. It took us a year to get it out.
So on the last panel, there was a conversation about how there are moments in a company's timeline where it makes sense to consider M&A. Lisa, we'll start with you. When does a company know that they've hit one of those inflection points where it makes sense to say, yes, we should lift our head up and consider this? Maybe we won't do anything today, but we're at one of those moments where it makes sense to think about whether or not we should sell the company.
So I think there is a moment of, it depends on really what your objectives are, right? So I think there are some entrepreneurs who say, I want a proof of concept and I want to be able to have enough customers so that I can sell it and get on to the next thing, right? So do it early if that's your objective. More often than not, I think you want to maximize value, to be able to have a good product, a good customer experience, enough traction in the market to prove that it's a business that scales. Our first question for everything is, how scalable is it, right? And so to me, when you can prove out scale, that's the right time to say, is now a good time to sell? What are we solving for, both for your employee base, your company, or is there a second phase of scale that we want to get to that we're better off being solo, independent, nimble, entrepreneurial to do it?
Great. So is there anyone in the audience that has questions in a loud voice? I think there's one right there.
Hi, I'm Matt Bean from Loudon Street Capital. So I had a question sort of about the conversation there. You mentioned that a broker called you on the phone and said you had a deal available immediately. When somebody calls me like that, I immediately think deal, opportunity, discount. I want to take a look at it. Why do you not want to take a look at it? Like, what's going through your head that's making you say, I need to hang up the phone?
I didn't want to imply that we didn't want to take a look at it. But I think Chris's point was, you correct me if I'm wrong, it was we didn't know the company. They don't have a lot of connectivity into Microsoft. And I think we were trying to stress the point of early connectivity into the engineering and sales side of Microsoft is really important for us. And so it's just the barrier to try to get something done, particularly in the time frame that was given, which was a couple of weeks. It's nearly going to be impossible, right? We can't come up to speed enough in really knowing them to make an answer. So it's not that we won't look and I'll have a conversation with a couple of people. The chances of it coming to fruition are very, very, very low.
and I think it's good to be a little extreme. I think to Mark's point, I think yes, we'll take a look, and then the right answer for me to say is if we can get to a value that's like if we can have a DCF that says we should buy it, sure, we'll buy it. But at the end of the day, it's not happening. It's the connectivity, the integration pieces are super important. You guys talked about this in the last panel. We have to think about that. We're not a holding company. We're not a private equity firm. I think the question you had is like private equity guys should be all over it, right? But we're running a business by which we want A plus B to equal a little bit more than A plus B. And so having those relationships, having that connectivity, having the mechanism for us to think through those things, it's incredibly important for us.
And we have pipeline reports, right? So we know what capability gaps, what businesses we are proactively looking for, and there's companies that hit that list. If I show up at an executive committee meeting and say, oh, and here's one, they're going to say to me, why was that not on the list? Like, did you just discover it? So on the strategy leads to execution, it's really important to get to know the company sooner so that you're on that pipeline report and it's not starting from a standing start.
Are there other questions?
Yeah. Hi, Jeff Gapson with Prime Revenue. How has the abundance of capital at financial sponsors changed, or has it changed the way that you guys run your processes? Do you feel that you're competing more aggressively with them? Has it made you change the way that you approach M&A and Corp Dev?
It's changed. Well, you mentioned sponsors. I think sponsors and VCs on our side, we're usually buying pretty high growth companies. It's changed the world a lot, right? Because before it was like, oh, we want to sell, there's no real other alternatives. Maybe the IPO market's open, maybe it's not, but there's not a ton out there. And nowadays you have, we can talk about SoftBank and what's going on there, but there's a lot of other firms like SoftBank who just have tons of money and are willing to frankly match us, if not beat us from a valuation perspective. And so I do think it's just created more alternatives for sellers out there, and it can make it harder to get a deal done, honestly.
One thing I would add, and kind of tracks back to the last question from the thing, is that when you're asking about when do you know it's time to sell, and I think what admonition is, because the capital is so plentiful, there are a lot of companies out there that have valuations that frankly probably aren't very sustainable. And information is asymmetric. As a CEO, you probably have a good sense of like what your real revenue growth rate is or what your real internal metrics are. And the thing is, if you have signs that you're not getting to what your valuation says you need to be, that's a cause for real concern. And so I think that at some point things will come back into balance where people aren't just looking at the top line number or the headline number of the last financing round, but it's just a very dangerous situation a CEO puts him or herself into when you have to execute at such an extreme only to just justify what that headline number is.
One more question from the audience, and then we'll do advice. Anyone else in the audience with a question?
Hey, thanks so much for being here in Atlanta and talking about this topic that we don't get to hear about enough. My curiosity is, and my name's Kyle Porter with SalesLoft. My curiosity is, how do you expect changes in the macroeconomic climate to affect the work you all do for the next year and through the election?
It's a great question. I think there are a lot of aspects to it. One goes back to the conversation we were just having, which is with the amount of capital is out there, I think there will be, while there's probably a dip and therefore a day of reckoning for companies that are overvalued and therefore not performing against what their goals were. But what the capital gives you optionality and allows you to sort of swim through those, depending how deep it is, those periods of time where things aren't as progressing and the growth side as you might like. I do think that boards in general, when those signs really become real, do then think about M&A as an alternative. So I think we will see a little bit more M&A when the recession hits, whenever it hits. In general, though, it doesn't slow us down. We're still going to do between 15 and 20 deals next year, and so for what I do, it's not that important. But I think we're going to see more companies for sale in that period.
I think one thing I'd like to add, so I was running M&A at a company called Success Factors during the 08, 09 kind of 10-ish downturn. And I actually really thought that, it would be buying season. And what I really found out, which actually shouldn't be surprising, is that the companies that we gravitated towards were actually the higher quality ones that turned out to be much better in control of their own destinies. So they didn't really need to sell. And a lot of the companies that we really thought like, well, this company is not really what it's all cut out to be, were all the ones that were like the desperate sellers. And so there was very much like a world, I call it haves and have-nots. And so kind of getting back to the basics, it's like, really thinking about what cash flow break even is and what does it take to do that. As you think about macro, puts you in a much better position to have an M&A discussion with a corporate buyer than being in the situation where you have to raise capital.
So perhaps we'll end with going down the panel with advice for the founders in the audience. Macy, you want to start?
All right. So I knew this was coming. I would say, know what you want. Is value maximization more important than finding the right home for your employees or figuring out if the acquiring company is going to keep your products and services alive in a way that you're happy about? And when you know what you want, you can have a conversation with us that gets to a very real, can we get a deal done or not?
I think leveraging a little bit of what we just talked about, it's capital's everywhere. You can do whatever you want with it. You can grow as fast as you want, and you can spend a lot of money growing. Realize that if you want to ultimately sell your company, we have to take all of that on. And so I think it's just a matter of being smart, running your business as you always would and as you would intend to, but be smart about the way you're running it and the way that an acquirer, if you want to sell, acquirer will look at that and it can be tough for us to wrap our arms around a lot of the ways that you might be thinking about growth relative to the way we think about growth. And so at the end of the day, all this comes down to is be smart about the way you're running your business.
I think maybe the only other thing I'd add on top beyond the kind of know what you want is that, like most things, it's like a really long game. So whether you're first or second or third time entrepreneur, like memories are very long. So like how you behave during like a sales cycle and what you represent, how you treat your investors, how you treat your customers, how you treat your employees, like this will have long lasting effect, long beyond just the selling of this business in and of itself. So I always recommend people think about the long-term reputational effect of what they're doing in the moment, because it really does stick with you.
And I would have two things. The first is make sure you get alignment with your board and control shareholders. So often we see that there's misalignment there, at least at the beginning, and that just prolongs the process and makes it difficult to actually get a deal done. So alignment with your board. And the second thing, very simple, you learned it in kindergarten, don't lie. People have heard me say that before. Don't lie. Don't prevaricate. Don't shade the truth. Don't lie.
It's a good place to end. Lisa, Chris, Sexton, and Mark, thank you.